What happens when you push a small snowball down a hill? And what does this have to do with growing wealthy? When you push a small snowball down a hill, it continuously picks up snow. When it reaches the bottom of the hill, it is a giant snow boulder. The snowball compounds during its travel down the hill. The bigger it gets, the more snow it packs on with each revolution. The snowball effect is a metaphor for compounding. It explains how small actions carried out over time can lead to big results. In the same way, investing in high-quality dividend growth stocks can generate large amounts of dividend income over long periods of time. Investors looking for the best dividend growth stocks should consider the Dividend Aristocrats, a group of 65 stocks in the S&P 500 with 25-plus consecutive years of dividend growth. This video shows how to harness the power of the snowball effect to multiply your wealth and income many times over. It also includes 5 real-world examples of the snowball effect, stocks that have compounded investor wealth. Before we have a tendency to begin, why don't you hit the subscribe button? And therefore the bell notification icon, thus you never miss any of our videos. Let's begin. Before we discuss how to harness the power of the snowball effect, we must understand the power of compounding. The snowball metaphor visually shows the power of compounding. The most powerful force in the world is compound interest, attributed to Albert Einstein. Here's the power of compound interest. Imagine you invested $1 that compounded at 1% a day. In 5 years your $1 would grow to over $77 million. You would be the richest person in the world by year 7. Keep in mind that compounding is not a get-rich-quick scheme. It takes time, and lots of it. There are no investments that compound at 1% a day in the real world. The stock market has compounded wealth, adjusting for inflation, at 7.0% a year over the long run. At this rate, an investment in the stock market has historically doubled every 10.3 years. It takes more time to compound wealth in the real world, but that doesn't make the principles of compounding any less powerful. Take Warren Buffett as an example. Warren Buffett is worth over $80 billion. Warren Buffett's wealth comes from the tremendous benefits of the snowball effect through time. Warren Buffett compounded his wealth through a specific type of investment. Specifically, Buffett invests in 1. Shareholder-friendly businesses. 2. With strong competitive advantages. 3. Trading at fair or better prices. All there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. Warren Buffett. How you can harness the snowball effect. You can harness the power of the snowball effect by investing in the same type of businesses that have made Warren Buffett so wealthy over time. Looking at Berkshire Hathaway's portfolio, its top 5 stocks, as of its most recent 13F filing, make up 77.5% of the portfolio. 43.86% is invested in Apple Inc. AAPL 12.67% is invested in Bank of America, BAC, 8.77% is invested in Coca-Cola Co., 7.08% is invested in American Express, AXP, and 5.09% is invested in Kraft Heinz, KHC. These 5 businesses are the core of Warren Buffett's current compounding machine. Do you know what's interesting about these 5 businesses? All 5 are well-established businesses that pay dividends. 1. Apple has a 0.7% dividend yield. 2. Bank of America has a 2.9% dividend yield. 3. Coca-Cola has a 3.3% dividend yield. 4. American Express has a 1.8% dividend yield. 5. Kraft Heinz has a 5.4% dividend yield. The average dividend yield of Berkshire Hathaway's top 5 stocks is 2.8%. Warren Buffett holds a concentrated portfolio of businesses with above-average dividend yields and long histories of dividend payments to shareholders. Investing in this type of business is the surest way to benefit from the snowball effect. The good news is you don't even have to search for these businesses. There is a list of 30 businesses with 50-plus years of consecutive dividend increases called the Dividend Kings list. Nothing says long-term success like 50 or more years of paying rising dividends in a row. Coca-Cola, one of Buffett's biggest investments, is a dividend king. There are many other well-known stocks in the Dividend Kings list, including Procter & Gamble, PG, 3M, and Johnson & Johnson, J&J. You may think, these businesses may have a history of success, but isn't their run over? Investors have wasted tremendous sums of money chasing the new hot stock. You cannot benefit from the snowball effect by investing in businesses that are unproven. Steady dependable results lead to wealth multiplication. What would happen if you had invested in some of the most well-known dividend kings in 1990? The 7 examples businesses below all had 25-plus years of consecutive dividend increases by the end of 1990. They were well-known, blue-chip stocks in 1990. It didn't take a genius to buy and hold them. But the results speak for themselves. 5 examples of the snowball effect in action are below. All examples assume dividends were reinvested. Example number 1. The Coca-Cola Company Co. Coca-Cola compounded investor wealth at over 14% a year, including dividends, over the last 30 years. Coca-Cola was the largest soda brand in the United States in 1990. And had a 98-year operating history at the time. It was not a startup. Coca-Cola stock ended 1989 at a share price of $1.03 per share, adjusted for splits and reinvested dividends. The stock closed at $53.86 per share on December 31, 2019. That means the stock generated annualized returns of 14.1% per year over the 30-year period from 1990 to 2019. Example number 2. Lowe's Companies. Lowe's is the second largest home improvement store in the United States, behind only the Home Depot, HD. In 1990 Lowe's was one of the largest home improvement stores in the United States. It had a dividend history of over 25 consecutive years of increases even then. Investors in Lowe's 30 years ago have done very well. Lowe's ended 2019 trading at an adjusted price of $118.37. With an adjusted price of 9 cents to end 1989, accounting for stock splits and reinvested dividends, Lowe's stock delivered compound annual returns of 27% per year over the past 30 years. This means a $1,000 investment 30 years ago would be worth just over $1.3 million to begin 2020. Example number 3. Procter & Gamble, PG. Procter & Gamble was just as well known in 1990 as it is today. The company has an iconic brand portfolio with names like Tide, Bounty, Gillette, and Charmin, among many others. The company was founded in 1837. In 1990, Procter & Gamble had been around for 153 years. Not exactly a young company. Still, long-term investors in Procter & Gamble have done well. Every $1 invested in Procter & Gamble at the end of 1989 became nearly $70 by the end of 2019. This comes to a compound annual growth rate of 15.2% a year. Example number 4. Colgate-Palmolive, CL. Colgate-Palmolive traces its history back to 1806. Both the Colgate and Palmolive brands are easily recognized. In addition to these brands, Colgate-Palmolive owns the Speed Stick, Soft Soap, and Hill's brands, among many others. Colgate-Palmolive has paid dividends since 1893. The company has paid increasing dividends for over 50 consecutive years. In 1990 the company had a streak of 27 consecutive dividend increases. How did 1990 investors do? Every $1 invested in Colgate-Palmolive stock grew to $262 from 1990 to 2019. Colgate-Palmolive generated a compound annual growth rate of 20.6% during this 30-year period. Example number 5. Johnson & Johnson, J&J. Johnson & Johnson is currently the largest healthcare corporation in the world. The company is one of the most stable businesses in the world as well. This stability is reflected in Johnson & Johnson's long history of dividend payments to shareholders. This slow and steady business has been a boon for shareholders over the long run. Every $1 invested in Johnson & Johnson stock at the end of 1989 grew to $75.41 by the end of 2019. The company generated compound returns of 15.5% a year for shareholders during this time period. The company's low stock price volatility only adds to its appeal. Investors have historically generated excellent returns with Johnson & Johnson stock without as many gut-wrenching ups and downs as compared to other stocks. That's it for nowadays. We tend to hope you learned a few tips. If you're still here, then I bet you enjoyed the video, provides it a thumbs up, and don't forget to subscribe if you haven't already.